As you know, markets sold off today, but what about tomorrow's trade? Stock and bond markets around the globe will be closely watching tomorrow's U.S. jobs report. Joining us now with his preview of that release is Bloomberg best economist John Herrmann. He's senior fixed income strategist over at State Street Global Markets. John, good to have you back here on Street Smart. So what should we be getting ready for tomorrow?
I think what we have to prepare ourselves for the next coming few reports is to be thinking along the lines of more or less moderate to soft private payroll gains, continued pressure in state and local government hiring. And we don't think the unemployment rate is going to rise this month in tomorrow's report, but we think over the next couple of months it's going to continue to rise and should probably get up to about 9.4% before the year is over.
So we don't have high expectations for this release tomorrow, John. Non-farm 85,000, private 113,000. What do you think that's going to do to market sentiment that's been badly bruised already at today's session?
You know, people are going to look through the report pretty carefully. I mean, you know, the thing is that if the report comes out, say at say something closer to the report comes out closer to like 0 or negative, then I think people will be very concerned. But in the event that it produces a gain of, say, 75 to 100,000, I think markets may be just a little bit relieved. They'll look through the report, and there should be several components where you actually see job gains. We should see gains in motor vehicles, perhaps in manufacturing. We should see it also in mining. We should see it in education, healthcare. We should see gains also, smaller gains in wholesale trade and in transportation. So we should see some gains. Not every sector is going to be negative, but there will be a few sectors that are soft and that are weak and negative. And so market participants are going to look for a balanced view.
All right, balance. Hey, listen, John, you kind of freaked me out when you sent me third quarter 2011 real GDP growth of 1.85%. I mean, that really scared me. I mean, it doesn't look good. I mean, describe what the second half is going to be like. Could we get that double dip that people are starting to increasingly talk about?
Yeah, so I think, you know, as you mentioned, the third quarter looks like we can achieve, you know, close to this, close to 2%. It looks like we can get there, close to it, maybe a little bit softer. But looking out past that, we have more concerns. And we look for growth to barely improve on that in the fourth quarter. And we actually look for growth of closer to 1% in the first quarter. So we're very concerned as we roll forward in time. And, you know, but if we have growth that weak and we're on that type of trajectory, then it doesn't take much of an adverse shock to sort of tip us over. So that's the scenario that we're kind of worried about.
All right, so it doesn't take us much to kind of go over the tipping point, but you're not betting on a recession at this point. Still too early?
Yeah, I mean, you know, basically the way we're expressing our concerns is we're in a 2-10s flattener. We've been in it for a couple of weeks now. And we think even with the tremendous moves that we've seen in it, we think it could still extend further as the 10-year yield continues, the 10-year Treasury note continues to rally. The Fed may at some point respond to all this growth changes by announcing maybe just a subtle change in their management of their portfolio. What they may end up doing is, without announcing, say, a new round of QE3, they just may simply say, look, we're going to buy more longer-dated maturities, extended duration in the portfolio, and the Fed would then, in turn, sort of reinforce the down move that we've seen in 10-year yields and could drive it closer to 2%. That, in turn, could trip off a mortgage refinancing wave, and you know, perhaps, you know, get the economy going a little bit, and without really enacting, say, a new type of QE.
Hey, John, I got to jump in and ask you: is this really just proof positive that all the stimulus didn't really work? It just wore out.
You know, yeah, I would tend to be more in your camp. The thing is, the consumers still have about $3 trillion of deleveraging to go. And that's going to take about 5 years or longer to do it. And, you know, there's not too many gimmicks that you can do that are going to get us out of that environment. So, you know, I would agree with you that, you know, the consumer really has been propped up for the last couple of years by tapping into savings, you know, using home equity loans and taxes, transfers, hosting. They've even defaulted on portions of debt to go spend.
Right.
But, you know, at some point you sort of run out of those kind of gimmicks.
It definitely feels all sobering. Hey, John, thank you so much.